Piran Engineer, CLSA, a senior research analyst, and talk about the entire banking space in general. And Piran, thanks for joining us on the show. Now, MFI stress is rising. Some banks are indicating that Q3 will also see some further stress in its system going ahead. We've got banks the likes of Bandhan Bank and IndusInd Bank with heavy MFI exposure as well. So how should investors sail through this turmoil? What's your outlook going ahead, at least on the MFI front?
Yeah, so see, I think, you're right that it's a system-wide issue, it's not a geography-specific issue, and a lot of it is driven by over-leverage at the customer level. Our analysis indicates that average customer indebtedness is up almost 50% over the last 4 years compared to pre-COVID levels. And naturally, with the new risk guardrails coming into place a few months back, that has led to some delinquencies in the sector. Our approach here, by and large across the space, is a wait and watch approach. We've not seen such a situation before. Like in past crises, it's been more driven by an economic event on the ground, be it demonetization, be it COVID. Here, the good thing is that the income of the borrowers is intact. The bad thing is that the size of the debt per customer has ballooned. So that's really how I would look at it out here. And as you rightly mentioned, Bandhan and IndusInd have large MFI portfolios. However, for IndusInd, as a percentage of their overall balance sheet, it's less than 10%. For Bandhan, it's almost half of the book. So that's, I think, just from an overall perspective, what most managements indicate is that the stress will last for another couple of quarters. They don't have visibility of A, when it improves, and B, how severe it gets in Q3. Hence, we have more of a wait and watch approach out here.
Right, Piran, the rate cuts are unlikely during the next meeting, but during the event of rate cuts, how should one allocate their funds? Should one focus on housing finance companies? I believe PSUs have higher exposure to benchmark-linked loans.
That's a good question. I think, see, in the event of a rate cut, and the top 4 private sector banks will be fairly uniformly impacted because all of them have 50 to 60% of repo-linked loans, and the rest being MCLR and fixed-rate loans. The 5th largest, which is IndusInd Bank, has a slightly more different structure. They have more of fixed-rate loans and less of repo-linked loans. Now, our analysis of a sensitivity to rate cut indicates that for a 50 pip repo rate cut, in the immediate quarter, you would see ballpark 18 to 20 bips NIM compression across the large banks. However, as the deposits start repricing and assuming a repricing tenure of 6 to 8 quarters, the eventual impact across banks will be less than 10 bips. Now, again, your portfolio positioning depends on the tenure of your holding. If you're a near-term investor, you want to avoid these names. I think if your time horizon is beyond a year or two, the eventual impact is not much. And I think from that point of view, it makes decent sense if you can wait it out. When it comes to the HFCs, and here I will give a ballpark view. Across most HFCs, 90% plus of assets will be at floating rate, most of the large HFCs, because home loans are effectively, whether or not you link it to an external benchmark, even if it's an internal benchmark, that internal benchmark moves in line with the external environment, right? On the other hand, if you look at some of the large HFCs, more than 50% of their borrowings are at fixed rates. So in the near term, you get that ALM mismatch. So like you have that NIM compression for banks, you have it for HFCs, only much more severe. I think the NBFCs that benefit are the ones that lend at fixed rate, for example, the vehicle financiers or credit card loans, personal loans, etc., because there the assets don't reprice. So that's really the broad outlook in a rate cut scenario.
Okay, got your point there, Piran, but the system deposits growth have been lagging loan growth lately. Do you see any early signs of revival, at least on a broad basis? Do you think can it slow down the loan growth on the flip side?
Let me answer your first question. I think deposits were lagging or deposit growth was lagging loan growth in the recent past because it exceeded loan growth between 2020 and 2022. Now, just to recap, back then we had COVID, RBI infused a lot of liquidity in the system, banks were unwilling to lend, so they hoarded up on excess liquidity, etc. And therefore your deposit growth was faster than your loan growth, LDRs went down. In the last 2 years or 2.5 years, you've seen a mere unwinding of that trade. And the loan to deposit ratio today, if you adjust for the HDFC merger, is ballpark equal to the LDR 4 years ago. It may be 100, 200 pips higher, but ballpark equal. So I think out here, it's not true that it's been lagging loan growth for a long time. In fact, our analysis of a 10-year history suggests that loans and deposits both have grown in line with each other. An analysis of a 20-year history suggests that loan growth has been about 150 bips higher than deposit growth. But that's also because of a change in RBI's SLR norms. And as SLR requirement was reduced, banks could redeploy those same investments instead of those same deposits from investments into loans, and therefore loan growth was faster. So that's point number one. I think your second question on whether deposits, lack of deposit growth will be a constraint to loan growth, I think here we have a different view. Loans create deposits and not the other way around. I think it's widely perceived that deposits create loans. That's not true. Loans create deposit, and as long as there is loan creation in the economy, either by RBI or commercial banks, deposits will be created. Deposits may manifest in another way. It may manifest as a wholesale deposit, or as a CASA deposit, as a retail term deposit. Manifestation could be different, but the liabilities are created by assets. So I would not see that as a constraint.
If you like this video, then like, share and subscribe to ET Now.